In today's complex economy, financial institutions play a pivotal role in the flow and management of money, influencing everything from individual savings to global markets. These institutions provide essential services that facilitate economic growth, stability, and prosperity by acting as intermediaries between savers and borrowers. Understanding the intricate relationship between financial institutions and money is crucial for anyone looking to navigate the modern financial landscape. We will explore the various types of financial institutions, their functions, and their impact on the economy, highlighting their significance in managing money effectively. Financial institutions are categorized into several types, each serving distinct functions within the economy. The primary categories include commercial banks, investment banks, credit unions, insurance companies, and asset management firms. Commercial banks are perhaps the most well-known, providing services such as deposit accounts, loans, and payment processing. Investment banks, on the other hand, specialize in underwriting new debt and equity securities for corporations, facilitating mergers and acquisitions, and providing advisory services. Each type of financial institution contributes uniquely to the overall financial ecosystem, ensuring that money flows efficiently through various channels. The role of financial institutions in the economy cannot be understated, as they facilitate the movement of money and credit. By accepting deposits from individuals and businesses, these institutions gather capital, which they then lend to those in need of funds. This process not only helps to finance consumer purchases, such as homes and cars, but also supports business expansion and innovation. Additionally, financial institutions engage in risk assessment to ensure that loans are granted responsibly, thus promoting economic stability. Ultimately, their ability to mobilize resources is critical for economic growth and development. Moreover, financial institutions contribute significantly to monetary policy implementation. Central banks, which are a type of financial institution, play a crucial role in regulating the money supply and interest rates to promote economic stability. By adjusting these parameters, central banks influence lending rates, consumer spending, and overall economic activity. For example, during periods of economic downturn, central banks may lower interest rates to encourage borrowing and spending, thereby stimulating growth. This interaction between financial institutions and monetary policy is vital for maintaining economic equilibrium. Another important aspect of financial institutions is their role in providing financial services that promote savings and investments. Through various products such as savings accounts, certificates of deposit, and investment funds, these institutions encourage individuals to save money and invest for the future. This not only helps individuals build wealth over time but also provides capital for businesses to grow and innovate. Additionally, financial institutions often offer education and resources to help consumers make informed financial decisions, thereby fostering a culture of financial literacy. Furthermore, financial institutions also play a critical role in managing risks associated with money and investments. Insurance companies, for example, provide coverage that protects individuals and businesses from unforeseen events, while asset management firms help clients diversify their portfolios to mitigate investment risks. By offering these services, financial institutions help stabilize the economy by ensuring that individuals and businesses are better prepared for potential financial setbacks. The risk management function of financial institutions ultimately contributes to a more resilient economic system. Financial institutions are indispensable to the functioning of modern economies, serving as intermediaries that facilitate the flow of money and credit, implement monetary policy, promote savings and investments, and manage risks. By understanding the various types of financial institutions and their roles in the economy, individuals can better navigate their financial futures. The role of financial institutions. Financial institutions serve as intermediaries between savers and borrowers, facilitating the efficient allocation of resources in the economy. They collect deposits from individuals and businesses, which are then used to extend loans to those in need of capital. This process not only helps individuals achieve personal goals, such as buying homes or starting businesses, but it also stimulates economic growth by promoting investment and consumption. Thus, financial institutions are essential for maintaining liquidity in the economy and ensuring that funds are available where they are most needed. Types of financial institutions. There are several types of financial institutions, each serving distinct functions and markets. Commercial banks are perhaps the most well-known, providing a range of services including checking and savings accounts, loans, and mortgages. Credit unions, which are member-owned cooperatives, offer similar services but often with lower fees and better interest rates. Investment banks, on the other hand, specialize in helping organizations raise capital through securities and providing advisory services for mergers and acquisitions. Understanding the different types of financial institutions is key to recognizing how they contribute to the overall financial ecosystem. Services provided by financial institutions. Financial institutions offer a diverse array of services that are critical for both individuals and businesses. These services include savings and checking accounts, loans for various purposes, investment opportunities, and insurance products. By providing these services, financial institutions help individuals manage their money more effectively, plan for the future, and protect against unforeseen risks. For businesses, these institutions play a vital role by offering lines of credit, facilitating transactions, and providing financial advice, thereby enabling them to operate efficiently and grow sustainably. Impact on monetary policy. Financial institutions are central to the implementation of monetary policy, which is the process by which a government or central bank manages the money supply and interest rates to influence economic activity. By adjusting interest rates, central banks can encourage or discourage borrowing and spending, which in turn affects inflation and employment levels. Financial institutions are the conduits through which these policies are enacted, making them essential players in the management of the economy. Their ability to swiftly adjust to changes in monetary policy can significantly impact overall economic stability. Challenges facing financial institutions. Despite their importance, financial institutions face numerous challenges that can hinder their effectiveness. Regulatory compliance, technological advancements, and economic fluctuations are just a few of the issues that require constant attention. The rise of fintech companies has also disrupted traditional banking models, forcing established institutions to adapt or risk losing market share. Additionally, the global economy's interconnectedness means that financial institutions must navigate a landscape fraught with geopolitical risks and market volatility. Addressing these challenges is crucial for ensuring the stability and resilience of financial institutions. The future of financial institutions. Looking ahead, the future of financial institutions will likely be shaped by ongoing technological advancements and changing consumer preferences. The integration of artificial intelligence, blockchain technology, and digital currencies is set to transform how financial services are delivered, potentially making them more efficient and accessible. As consumers increasingly demand personalized services and seamless digital experiences, financial institutions must innovate to meet these expectations while maintaining security and regulatory compliance. The evolution of these institutions will be critical in shaping the financial landscape in the years to come. In conclusion, financial institutions are fundamental to the functioning of modern economies, serving as crucial intermediaries that facilitate the flow of money. Through their diverse types and services, they play a vital role in allocating resources, implementing monetary policy, and supporting economic growth. However, they also face significant challenges that necessitate adaptability and innovation. Thank you for joining us on this financial journey. We hope today's insights have added value to your financial literacy. Remember, financial success is a journey, not a destination. If you enjoyed today's content, don't forget to hit the like button, share with your friends, and subscribe for more insightful videos.